영상이 시작되기 전에 먼저 등장할 5개의 문장을 보여드릴게요. 빈칸에 들어갈 표현을 유추해보세요. 단어 하나하나를 직역하지 않고 전체 의미에 맞게 의역하고자 노력합니다. 그게 바로 영어식 사고의 출발이에요. 그럼 시작해볼까요?
It's defying expectations. It really hinges on how people are reading the latest jobs data. Let them shrug off the inflation data for now. Outweighs those near-term economic worries. A sharp reversal.
Welcome to the deep dive. So we're looking at the materials and really digging into this big question a lot of investors have right now. U.S. indexes are near record highs. Some people talking S&P 500 maybe hitting 7,000. So why hasn't the market corrected yet? What's really going on here?
Yeah, it's fascinating, isn't it? It's not just that it's defying expectations, but sort of how selectively it seems to be reading the economic tea leaves. So today, we'll try to unpack the big forces driving this optimism, but also, crucially, look at the cracks, The risks hiding underneath that could still cause a pullback, which kind of leads to the big question, right? Is this a real Goldilocks moment sustainable, or are we maybe more of a melt-up situation heading towards an overheated peak?
Okay, let's kick off with what feels like the biggest driver people are pointing to. This growing belief the Fed's going to cut interest rates soon.
Exactly. And that Goldilocks idea, things being just right, not too hot, not too cold, it really hinges on how people are reading the latest jobs data. We're seeing some cooling, which is good, suggests inflation might ease off. But importantly, it's not collapsing into a full-blown recession. And that balance, that's what has bond traders pricing in multiple rate cuts through early next year. It sort of de-risks the future in a lot of people's minds.
Okay, but hang on. This is where it gets interesting for me. Inflation is still stubborn. CPI, PPI, they're not really dropping convincingly towards that 2% target the Fed wants. So given those numbers, why do you think traders seem so quick to just brush them off?
That's a really key point. It shows you where the market's focus is right now, doesn't it? It's very selective. Instead of seeing those sticky inflation numbers as a real problem, a lot of traders are kind of choosing to see them as, let's say, temporary noise. They're putting their money really on those weaker job trends. The argument is wage pressure will fade, so price gains won't stick around long term. It's that belief higher prices won't last that's really propping up the bullish feeling and letting them, shrug off the inflation data for now.
Right, makes sense. And then beyond the pure economics, you just can't ignore the AI story. That whole narrative is clearly grabbing investors' imaginations.
Oh, absolutely. And what's really key here is how the market sees AI. It's not just like a new gadget cycle. It's seen as this fundamental shift that forces you to rethink long-term growth potential everywhere. You see it in the headlines, right? Microsoft deepening ties with OpenAI, NVIDIA shipping its latest chips, SK Hynix talking about next-gen memory HBM4. That's the high bandwidth memory needed for these powerful AI systems. Every announcement just reinforces this idea that AI is structural. It means more hardware, more data centers, huge capital investment. It's a growth story that, for many, just outweighs those near-term economic worries.
Okay, so we have this really strong bullish story driven by rate cut hopes and AI enthusiasm. What then could actually knock this off course? What are the real risks that could trigger that pullback we talked about?
Yeah, if we step back and look at the bigger picture, there are definitely some real potent risks that could unravel things pretty quickly. First off, the bond market. Current stock valuations are super sensitive to interest rates. So if inflation does surprise to the upside, maybe that temporary noise isn't so temporary after all, then long-term bond yields could spike again quickly. And that would hit equity valuations hard, especially in tech, where growth expectations are so high.
Okay, so bond yields are one. What else?
Second, geopolitics. You can't ignore it. U.S.-China trade relations are still pretty fragile. Any flare-up there could mess with supply chains, corporate earnings. And then there's the ongoing Russia-Ukraine conflict. It keeps casting a shadow over energy markets, creates volatility, and just generally keeps global risk appetite, somewhat cautious. These aren't small things. They're potential game changers.
Right. So, okay, optimism is clearly in the driver's seat for now. But interestingly, some of those same bullish voices also warn about a possible melt-up. Like a surge that's maybe driven more by momentum, by FOMO, fear of missing out, than solid fundamentals. Which could end pretty badly, couldn't it? A sharp reversal.
That's the central tension, exactly. That's what you really need to grapple with. Are we in a genuine, sustainable Goldilocks phase that can actually last? Or are we maybe accelerating into an overheated peak, setting ourselves up for that melt-up scenario? For now, the market's definitely chosen optimism, but it leaves us with this really interesting final thought to chew on. When almost everyone expects a correction, and it still doesn't happen,
Yeah.
does that make the eventual pullback more likely, maybe more severe, or does it somehow absorb the pressure? It's a strange kind of paradox, isn't it?
영어와 시사 경제 두 마리 토끼를 한 번에 잡는 알찬 시간 되셨다면 구독과 좋아요를 꾹 눌러주세요. 감사합니다.